The bond market is gearing up for one of the most significant Treasury refunding announcements in recent memory, and it could spark a bit of a wild ride. At its quarterly refunding report on Wednesday, the Treasury expects to boost issuance just as the Fed begins paring down its balance sheet. Let's head over to Singapore. Rajeev De Mello, who's the head of Asian fixed income at Schroder Investment Management, joins us there. Rajeev, I mean, this is not usually an event that we would pay attention to, but very closely fixated this week. Are you expecting some volatility when it comes to that yield curve?
Thank you, Heidi, for having me on your program. Right now, in a situation where central bank policy in Europe and in the US is on a predictable course, very well communicated, very gradual, I don't expect emerging markets and Asian bonds and currencies to be roiled by this Treasury announcement, refunding announcement. We have seen Treasuries in a range. Even if they go up slightly higher, they're accompanied by solid fundamentals. The global economy is picking up slightly, not too much to cause central banks to indicate they would have to accelerate any tightening pace. Everything seems to be very gradual and on course. China is growing well. All these combine very well for emerging markets and for Asian bonds in general.
And you see further opportunities when it comes to high yield space areas, local bonds in the EM space, and that's really on the assumption that you get a very, very cautious, like, what is it, like watching paint dry or grass grow, whatever Janet Yellen said, pace of normalization for not just the Fed, but across G3.
Yes, exactly. In that environment where yields are not, government bond yields are not going to do very much, investors have to look for yields elsewhere. And I mean, we're not seeing any signs of increased volatility. If we look at volatility indices in the equity markets, if we look at volatility in the U.S. Treasury bond market, that's all very quiet. Currency markets are quiet as well. So this is really the type of environment, especially in the middle of the summer, where investors are focused on carry for the time being. And yes, higher yielding bonds do benefit from these types of flows, which we've seen in the past couple of weeks.
Well, indeed, this is typical summer, though, isn't it, Rajeev? What are we going to get in the autumn?
Well, Rish, that's the question. Typically, September always becomes a little bit less stable. We do have, Jackson Hole coming up in a few weeks' time. We have also expectations around a change at the Fed's helm. Who's going to succeed Janet Yellen? That'll be a topic for September and October. So there are some causes for worry. Right now, a stable factor remains China until the fall meetings. We don't expect anything significant to happen in China in terms of the macro situation. In other major countries as well, things are generally stable. Inflation is also extremely stable and low, below target. But, coming into fall, some of those temporary factors that the Fed's alluded to, such as, mobile phone pricing, etc., could actually start reversing, and we could see a little bit of an upswing in the inflation numbers, which could give the markets a bit more of a jitter. So I agree with you. Going into September, October, that's when we should start becoming a little bit more concerned.
And Rajeev, of course, this dollar move to the downside surprised a lot of people. I mean, does it have more legs?
Well, the currency moves tend to actually have fairly long cycles, and this one, is only about 6 months old. So I think that it does have more legs. The pace has been quite quick, but as we all remember, following the U.S. presidential election, we did see the dollar move up quite sharply, so we reversed that. Now, the dollar versus currencies is really a question of relative growth. The U.S. is roughly stable. It's recovered a bit, but it's not accelerating, whereas other countries, such as other regions such as Europe and Japan, are actually recovering a bit faster. So that does help their currencies. And I do think that, the dollar can continue to weaken, though perhaps at a slightly slower pace than what we've seen most recently.
Rajeev, one of the things that you note is potentially, we keep talking about this party congress in Beijing. We kind of just want to get to the other side of it, right, to see what policy changes will emerge. Do you think that potentially the markets investors are actually underpricing some seismic changes? And if so, what could they potentially look like?
Well, it's always very difficult for the markets to anticipate beyond such a big event such as the Party Congress. And I think that for the time being, everything's done to keep this uber stability in the Chinese financial system and in the Chinese economy in general. But once that's passed, perhaps the leadership will have, some options in terms of reforms. And, there are some reforms which we hear about in terms of SOE reforms, in terms of currency policy reforms. Some of those could be implemented and increase volatility in some of the sectors. So I think that's important. Another big question is really China going to keep its growth target where it is, or is it going to abandon a growth target and move, like other countries, to just managing the cycle? But it could also reduce its growth target, which would have impact on other emerging markets as well. So those are the types of changes that could occur after the Party Congress.
Rajeev, tell me about what's happening in China with a lot of these companies, under the pretext that they're actually being forced to pay off their debts, deleverage, in other words. How does that work out for corporate bonds? Not just, of course, the ones issued in China, but I'm talking about the ones, perhaps these dim sum bonds, which we've seen a lack of supply of, but other similar dim sum bonds around the world.
Well, generally, if you look around the world, the corporate spreads have come in on this low volatility, on this hunt for yield. So there's been a demand for yield, which is, an important factor in the markets right now. While, credit quality has deteriorated slightly, it's really been offset by the higher liquidity. So you'd really need to see a change in both the quality of the issuance worsen and demand dry up. Now, one of the causes, of course, could be the ECB's tapering of its policy. It's been a buyer of European corporate bonds, which has forced European investors to buy U.S. corporate bonds, and they've bought emerging and Asia in turn. So as central banks start unwinding some of their balance sheet purchases, that might have an impact on corporate bonds more generally. Now, in terms of China itself, we had seen quite a significant widening in spreads, and that started to reverse.